All right, we are back. Episode 4 of the Press Finance podcast. We are here with Paul Marshall once again.
Thanks for having me back.
That's it. You've obviously done a good enough job. I've invited you back 3 times now, so that must be a good sign. So today we're going to talk about SMSF loans and how it works. We understood with the accountant on the last podcast how the structuring side of things work. Want to get you on and maybe talk about the lending side of things. So yeah, we'll get right into it. Let's start off the bat with what is an SMSF?
Well, an SMSF is a self-managed super fund loan.
Yep.
It's where someone will do a loan within their superannuation fund, their self-managed superannuation fund. They lend against that. It's always in the name of a bear trust as trustee for the superannuation fund. And it's a great way to create wealth, particularly if you're looking at investing or certainly looking towards, financing your future, SMSF loans have certainly become quite popular.
Mm-hmm. Why do you think people are interested in this? Like, why do you think it's something that now people are starting to turn to and realize this is more of an option?
Yeah. Because of first of all, I probably need to premise that the information that we're going to give today is of general nature only. Mm-hmm. If someone is interested in an SMSF loan, they really need to speak to either an accountant or a financial planner, someone that's got an AFSL licence, right? Australian Security and Financial Licence. We as lenders don't have that, so we can't talk we can't give any personal advice.
Of course, yeah.
So all we can give is general information. But typically why someone would do an SMSF loan would be to create wealth. And they do that, why they've become more popular is because of the tax savings on an SMSF loan. So when we buy investment properties and we have them for a period of time and we sell those investment properties, we pay capital gains tax, right? And outside your superannuation fund, capital gains tax is quite high, depending on what your level of income is, but typically somewhere around 37%. Don't quote me on that. I'm not an accountant. I'm not a...
That's it. Yeah.
But my understanding it's somewhere around there. When you do a loan in your SMSF, if you sell that property while you're still working, you only pay 15% capital gains tax. Okay, so it represents a significant saving. If you're in retirement phase, when you sell that property, you pay no capital gains tax. So you think if you bought yourself a property now at this point in time of your life for say $800,000, right? Then when you have retired, you go and that property. Let's say that property is now worth $2.5 million by the time the 20 years or so that.
Of course,
till you retire, probably a little bit longer for you.
Just a tiny bit longer. Yeah.
But let's say you've had it for 20 years, you've retired, it's now worth $2.5 million. Think about the gain on that from $800,000 to $2.5 million.
Yep.
If you're paying 37%. That's a significant amount of money.
Compared to paying no tax.
Compared to paying no tax. Yep. So that's the real reason why someone would do a self-managed super fund loan and why it's gaining popularity. Because, as we learn more and more about them, you think, well, why wouldn't I do a self-managed super fund loan?
And do you think that it is becoming a lot more popular now? I feel like all I see nowadays is YouTube videos, podcasts, shorts, reels, just all over the internet talking about SMSF. Is this something that maybe...
Look, it's probably gaining more traction now, but it's not as popular as I guess some of us would like it to be. I think there's still that stigma, particularly among brokers, that it is a complicated loan, where it generally isn't.
No,
But... and so as a result of that, I don't think you get as many people talking about self-managed super fund loans as what they should. We've got more people, I guess, specialising in SMSF rather than, the average broker doesn't do SMSF. Should they? I think so.
Well, definitely.
Absolutely.
Money left on the table for no reason. They're just obviously just going to go somewhere else if they do want to seek SMSF finance. Now, in the application stage of this, what is it that gets looked at? What is the documentation?
Yeah.
What's actually looked at when applying for a SMSF
Again,
loan?
these are non-NCCP loans, right? So they're written not in the name of a natural person. They're written in the name of
entity.
the Bear Trust as trustee for a superannuation trust. And typically these days, usually with corporate trustees. So you've got a company that's as trustee for the superannuation fund. That's in, and you would have discussed that with in the terms of the structure.
Of course, yeah,
right?
yeah. James.
In terms of doing the lending, the only documentation we really need from a personal point of view is really just the ID. You need a couple of pay slips or tax returns to verify the amount of super contributions, and typically, what else would you need? Really, a copy of your superannuation statement to show the assets that you've got in that superannuation fund. It's not dealt with outside of super. You pay for the repayments are made from the investment income from the property that you're purchasing, and any shortfall comes from the super contribution. So, the popularity is for a customer point of view is that you've got no actual money coming out of your cash flow. It doesn't affect your cash flow.
No, exactly. And that's what people do seem to realize there's a bit of gold there, because it's not, doesn't affect your week to week pay. You're paying your super anyway. I mean, your employer should be.
And honestly, if you've got a customer coming to you for an investment property, why are they coming to you for an investment property? They're coming to you because they want to grow their wealth portfolio, right? They want to buy that property so it can provide either a passive income for them, or they can pay it off and sell it, and they'll have an investment at the end of it to go towards their super. Now, what's better than having one investment property?
Having multiple.
Having two, right? Certainly, I would suggest that any broker have a look at, if they're talking to an investment customer, have a look at how much super they've got, and if they've got a couple of $100,000 in super, they can get a superannuation loan as well.
100%.
So better to buy, two properties and have one that you don't have to worry about from a cash flow point of view.
Exactly, yep.
And one that, yes, you do have to, or certainly some form of it.
Yep.
Both have different and specific tax advantages.
Yep.
Obviously, outside super, you've got the tax advantage of reducing your taxable income that you're paying. In your super fund, there is no actual cost, but you get that capital gains tax saving at the end of it when you sell the property. So.
No, exactly. And there are a lot of rules around lending and just overall SMSFs. So do you want to shed a little bit of light on the LRBA, Limited Recourse Borrowing Arrangement, how the loan is set up? So obviously it's attached with the Bear Trust, as you mentioned before, and the corporate trustee.
Yeah. And it is what you call an LRBA.
Mm-hmm.
An LRBA is a Limited Recourse Borrowing Arrangement.
Yep.
So what that basically means is that, and the SIS Act, which governs our superannuation funds, the SIS Act regulates that we can't actually borrow money directly from our superannuation fund. So the reason we do it in terms of where we use a Bear Trust as trustee for the superannuation fund is that is the only entity that is at risk. So let's say that you don't get a renter in that property for a period of time, and the lender has to foreclose on that property. The only entity that is actually affected is the owner of that property, which is the Bear Trust.
Yep.
Essentially.
So you are protected in sense, exactly.
You're protected. The only money that is at risk is the deposit that you've paid, the money you've paid towards that property, or in any repayments, I guess, or equity that you've gained in that property over that period of time. So yes, the risk, I guess, is losing that amount of money, but you don't risk the rest of your superannuation fund. So if you've got $1 million sitting in your superannuation fund, you pay $200,000 as a deposit on a property, that's all that's at risk.
Exactly. Yeah.
That and whatever
they can't reach up and grab the other.
Any of the other any
other
other
balance, yeah.
assets that you've got in your superannuation fund.
Yeah, which is a great thing, and I think that I'm sure that's protected a lot of Australians around.
That's what it means by limited recourse.
Exactly. Yeah.
It's limited by whatever assets the bare trust owns.
Yeah.
That's it.
No, 100%.
And on that, talking about the rules of superannuation funds, a bare trust can only own one property.
There you go. Yeah.
You can't have You can't have one bare trust owning multiple properties, right? It can only have one.
Which would be
So
another
when
layer of protection.
You want to buy another. You have one set up. You want to buy another one. You have to set up another bare trust for that particular property. If you want to get another one, another bare trust again.
There you go. Right. Yeah. So realistically, it's a very safe structure, and I think a lot of people do when they think of investing in their super, they think high risk. Naturally, because it is what you essentially save your entire life for, and to have that potentially affected by, a downturn in a market or a bad tenant or, all those things, where having that structure in place can really give you that confidence as a buyer and an investor. So that isn't as risky as it might seem.
I 100% agree with you. And if we look at historically, property is probably more of a safer investment than any, we look at the share market, yes, the crash in the share market, people lose a lot of money.
And instant,
right?
it's very instant when things like that happen.
Whereas property, you can lose money on property, but typically you don't lose as much, and it rebounds fairly quickly as well.
Yep.
So the chances of you, losing all your dough from, superannuation policy, property is pretty low.
Oh, 100%. And I've even had clients myself that, you have that original conversation with them and you ask, what their super's doing, and they don't even know. Like they don't even believe it's invested in shares. I've had a client that absolutely hates stocks and all that.
Yeah.
And I'll stay away from that. Now, mate, you've got a lot of money in shares right there. Did you know that? And he's like, oh shit, I didn't. And then that's where we look at potentially investing elsewhere with his self-managed super fund, where that's where such a powerful asset really, because you can take control of it, much like that's why it's called a self-managed super fund, because you
just
take
hang on
control
to
of
it
it.
just that little bit longer.
Yep.
It'll rebound. People, if you look at what properties are doing, we had a period there over, with the GFC and that where properties pretty much stabilised and didn't grow much, and there was a big downturn in the market. In fact, a lot of the properties did lose a little bit of money initially, but if you look at, that's 10 years ago, what those properties were worth back then to what they're worth now, you're probably talking somewhere around double, if not triple, what they were worth.
Exactly, and that happens all the time. Even look at recent things like, there's the war, the COVID, everything. Like they're all things that make you hesitant as a buyer. But then when you look, and hindsight's a wonderful thing, you zoom out and you realize it's doubled since then. You're like, oh fuck.
10 years ago,
yep,
the average median price of a property in Brisbane was 500,000.
Yeah.
What's the medium house price?
$1,080,000. I looked this up the other day. There you go. Yep.
Right, so we're double.
There you go.
In 10 years.
Yep.
Right.
Yep.
So now, bear in mind, that's in 10 years where there has been no real growth because of the GFC and COVID, and our interest rates were at under 2%. So it's taken a while for us to get back to any sense of, like, it's only really been the last 12 months or so that we've started to really, build on investments where people are starting to think about investment properties again.
Yeah.
It's been a long time since.
Looking forward, a lot of people are looking forward, and that's, I guess, why there is sort of like a hotspot in that SMSF market, because people are, we can touch on this a little bit later as well, but when you are maxed out in your own personal capacity, maybe exploring something like an SMSF is a good backdoor entry to maybe purchasing that extra property you might not have been able to do without your SMSF.
Yeah, spot on. That's exactly why. If you've got limited, income availability to purchase a property outside of super, have a look inside super.
Yep.
Have a look at if you've got 200,000 sitting in your superannuation fund. And nowadays, I remember when I was writing SMSF loans, and we're going back, probably
a long time.
damn it, about 10 years ago, I guess. The average LVR was 70%.
Yeah.
So, people needing 30% deposit. There were minimum assets you had to have in your super fund are around 250,000 plus, some higher than that. There was liquidity at 10%. So there was a lot of things in that prevented a lot of people, getting into that market. Nowadays, if we look at, we've just introduced a product that is exclusive to outsource, where we've got a 90% LVR, no liquidity, no minimum assets required. So long as you can afford the deposit, and if you're buying a $1 million property, there's $100 grand.
100%.
So long as you've got $100 grand plus costs in your super, you can buy a $1 million property in your super.
Yep. Yeah. So what once was maybe a $250,000 minimum in a super before you were maybe potentially looking at things like this, it's now much lower. So that's a good thing for the viewers to understand that. Maybe there's not a benchmark anymore. You don't have to get to over 200 and then start looking. Maybe you can look a little bit earlier, and you can combine up to.
And that doesn't matter whether you're self-employed or not self-employed. Even these days, the barrier for someone that's self-employed is that a lot of people who are self-employed don't always pay regularly into their superannuation fund. It's a big barrier because it's voluntary.
Yeah, because when you don't have to,
give
people
money
don't
away, or put money aside. We
Yep.
generally don't do that. But I think that the awareness now, people are doing that more and more. But let's say that you haven't got a huge amount of, you might have had an amount of super in your superannuation fund, but you hadn't been making a lot of contributions. With an accountant's letter or a financial planning letter, we can accept future contributions. So if you say, well, from now on, I'm going to, put 30 grand
this
a year
much into it,
in my superannuation fund, we'll be able to take that as repayment. So we're making it easier and easier for people to get into, these superannuation fund loans.
100%. And it's not just a single person thing. You can join people together and team up as a collective and invest with your super. It's up to 6, I believe it is. And
Correct.
And you can say you have $50,000 each. You don't have to wait till you're at $100,000. You can put something together. It could be you and your partner, you and your friends. A lot of people do it, and it's a great way to get ahead. Maybe when you're not necessarily ready, if that makes sense.
Good point, and that kind of leads on to the typical superannuation loan is mum and dad or husband and wife join their super together into a self-managed super fund, and they buy a property for their future. But it's not limited to just husband and wives. It can be a group of friends get together and buy, whether that be a commercial building, a residential building, anything. Generally the type of facility, it's exactly the same, but the superannuation trust typically becomes more of a unit trust rather than a discretionary trust. So most superannuation funds where we put them into a trust are usually discretionary trust or family trusts. With our when you're buying it in a syndicate with mates, so if us three were going into together, we would do it under a unit trust, and we would, depending on how much we're all putting in, that would give us so many units, out of that trust. So if you've got, say, 5 units in the trust, you have 2, and I have 1 because I'm cheap and I'm only putting in a bit of money.
Tight ass.
I'm almost retired as well, so I don't. So
let us do the heavy lifting, eh?
Yeah. So there are all sorts of options for different types of structures. So you're not limited to just one structure.
Definitely, and I think a lot of people people definitely know about it. There's a huge interest in teaming up as friends. I think a lot of people are realizing that, look, you can't just save your way to get ahead now. You've got to be a little bit aggressive nowadays if you want to invest properly. And I think that's really the turn. You got your group of friends, family, other people that sort of combine together and put their money where their mouth is and team up.
We're noticing that more and more, even in owner-occupied market. The cost of living and the cost of getting into a property nowadays is tough. And if you're single, how do you do it?
No,
you can't afford $1 million loan on your own. typically you need 2 or 3 people in that. But
Definitely.
you know, we've seen a lot of instances where you got 2 or 3 mates will pool their money together and buy a property. Now, I'm not saying go out and do that.
It's not always a good idea.
Can be quite risky because obviously if you have a fallout,
Yep.
you're
Which
stuck.
happens. Yeah.
But the options are there and you can do it. But more and more so with self-managed super fund loans, they're a little bit less risky.
No, exactly. Yeah, it's a lot.
You can
a lot of rules and legislation, so it's a little bit harder.
You can buy someone out, or you can get, they can sell their share, or they can, there's a lot more flexibility with it. Yeah.
Definitely. And going in with a clear plan, financial advice and legal advice is most of the time a settlement condition. So you need to have have a plan. And when you don't have a plan, normally you don't get rich on accident. You've got to have a plan. You got to invest properly. And if you're going in with a group of friends, these things need to be, very, very, very clear on what everyone's part is and everyone's goal. Someone might want to exit in 10 years. Some people might not want to do that. So you've got to have a plan, understand where everyone's at and have a direction that you're all going. Otherwise it just falls out from beneath you.
Yep. Spot on.
Yep. Well, I think that's pretty much it. I think we really touched on the lending side of SMSF and the pros and cons in a sense. And I think we've all learned a lot in SMSF lending. And I appreciate your time here, Paul, again. I'll have to figure out a new topic and pick your brain a couple of weeks from now.
No problem at all.
No, well, thanks for coming on. It was a pleasure.
No worries. Thank you.
Thank you.